So let's explore our first example, keeping or dropping a product line. And of course, this example extends itself to thinking about keeping or dropping a department or an entire business unit. In this example, we're talking about Scout Corporation. Scout Corporation has 3 divisions with the following financial results. Division A has sales revenue of $800,000, variable expenses of $520,000, ultimately resulting in a contribution margin of $280,000. Division B has a slightly smaller contribution margin of $90,000, and C trails with a $10,000 contribution margin. The fixed expenses for each of the divisions are allocated $80,000, $50,000, and $30,000 for A, B, and C respectively. So the resulting net income after subtracting all expenses from the revenue is $200,000 for Division A and $40,000 for Division B. Division C is the outcast here. It appears as though they are losing money for the corporation as a whole, with a $20,000 negative net income or loss. Now let's analyze this situation. Pretend we're a manager and we see these financial results, and oftentimes a manager might say, perhaps we should get rid of product line or department C. Reason is they're losing us some money. And if we didn't have them, we would perhaps make more money as a corporation. So the status quo currently right now with all 3 divisions is that we are earning a total net income of $220,000. That's the total net income for Division A, B, and C combined. I'm going to label that, as I said, the status quo, because that is what is existing currently. Now, if we were to drop product line C or Department C, we would lose the revenue that Department C is earning us. So we would have an adjustment to this $220,000 status quo amount. The lost revenue, which is revenue that was being added to create the $220,000 of net income, would be gone. So to eliminate its effect, we would subtract it. And that amount was $100,000. However, if we drop product line C, we save the variable costs associated with that division. So that number was being subtracted from company-wide revenues in order to earn the total net income. So to remove its effect, we would add that back. The saved variable cost, if we were to eliminate product line C, is $90,000. So taking into account just these items, the status quo is changed. It's $220,000 is what we were earning with product line C. If we were to eliminate it, we would lose the revenue of $100,000 but save $90,000 in variable costs. So that's a net impact of $210,000. The manager would say, this is not complete. They would say, what about the fixed costs that we would save? Well, then the question becomes, what happens to those fixed costs if we were to eliminate product line C? If those fixed costs were completely unavoidable, then the fixed costs would not be saved. The fixed costs that would be allocated to product line C would then be just divvied up between product line A and B if C were no longer there. So the end result would be the $210,000 that we've just calculated. We wouldn't save additional fixed costs. So again, if we can't avoid the fixed cost, then this is a bad decision to eliminate product line C. The reason is we've changed the status quo to a smaller net income number. If the fixed costs were avoidable, we would have a different story. The fixed costs then become relevant to our decision. The reason is because if we keep product line C, we incur those fixed costs, and if we eliminate it, we avoid them. Because the fixed costs are being treated differently across the different decisions, they become relevant to our decision. So if they're completely avoidable, we would also have saved fixed costs. And that would be $30,000. Adding back to the status quo, to subtract it to get to it, would mean that our new net income would now be $240,000. And this means that the decision is, from a financial perspective, favorable. As you can see, it all comes down to the extent to which fixed costs are avoidable versus unavoidable. And we need to understand and know more about how those fixed costs are calculated and or allocated to product line C before we can make this decision. Now again, we've just adopted a very simple example, and we haven't talked a bit about the strategic considerations or other qualitative considerations surrounding the decision to keep or drop product line C. We'll save that for future examples.